Managers communicate about the firm with investors and other stakeholders through financial statements. The balance sheet in the annual report provides information about what a firm owns, that is assets, and what it owes, that is liabilities. The liabilities like salaries payable, trade credit, debt involve future payments. These liabilities are easier to understand. However, there are some hidden liabilities that are not present on the balance sheet but are disclosed in the notes to financial statements. These liabilities are important as they affect the financial position of a firm. One such liability is contingent liability. These are liabilities where cash outflow is uncertain and the payment is dependent on a future event. For instance, Amazon in its annual report ended for the year 2022 disclosed estimated range of loss against claim for damages. If Amazon is not able to defend its position in the case, it will have to pay the estimated amount. Another important liability not present on the balance sheet is contractual obligation. To mitigate the risk of input price volatility, firms enter into contracts to purchase goods and services at a fixed price and quantity. In 2020, HP in its annual report disclosed $499 million worth of purchase obligations for inventory and service support. If a firm fails to fulfill its obligation under the contract, then it can result in significant penalties. Investors require information with respect to commitments and contingencies to assess their impact on firms' future liquidity and capital. Inadequate disclosures by firms can be misleading for investors. In my research, I examine the disclosures relating to contingent liabilities and purchase obligations for a sample of US companies. I examine how investors value these liabilities and is the valuation different from the liabilities that are present on the balance sheet. I also examine how these liabilities affect firm cash flow and risk.